Welcome to the HMO Property Show, by investors for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host Neil Gibb, and the RBA have slashed the cash rate as expected. I was expecting a little bit more, to be honest. I was expecting 50 basis points, but we got 25 basis points, and that is better than nothing, right? So today in the podcast, we're going to be diving into what that means for you as an investor, homeowner, or just trying to access lending for any way, shape or form. Or as we know, like we say, they have dropped the cash rate by 0.25%, which is down to 3.85% now. But what does this actually mean? Like, who are the RBA? How do they control this? Why are they changing rates? And what does this mean for you as an investor or a homeowner? So the RBA is the Reserve Bank of Australia, and it's basically Australia's central bank. Now, they're not here to help banks get richer, which is what you think they'd be doing. If they're dropping the cash rate, that means more people can get access to money, which means the banks will make more money. Yes, that is true. But the job of the Reserve Bank of Australia is actually to keep inflation under control, to keep employment low, and to keep the economy growing steadily. And this is why we always have like inflation in the background, because inflation means everything goes up in price over time, which means the economy is growing. And one of the ways they do this is by manipulating and changing the cash rate. And what we had pre-COVID was a lot of money in the system. Lending was cheap and a lot of people were buying stuff and spending money. So the RBA lifted the cash rate, which then meant more money was getting sucked back into the system, which then slowed people's discretionary spending down. And then inflation has got back into the rate that they want, which is between 2 and 3%, which means that they've done their job with a rate hike. And now as the economy is starting to mellow, they can now reduce the cash rate, which will stimulate the economy further. And the cash rate itself is it's the interest rate that banks pay to borrow money from each other overnight. It's like the wholesale rate for money. So when the RBA drops the cash rate, it gets cheaper for banks to borrow money. And in theory, they should pass on them savings to you. And, a lot of these banks are as well. So that's a good thing. So do they always drop the rate? Not always. I mean, when the RBA cuts the cash rate, banks can choose to lower their mortgage interest rate, but they don't have to. But the competition is fierce is out there now. We've obviously got the big four, which have got the monopoly. But there's a lot of smaller players in the market now. And whether you trust them to be there for 20, 25, 30 years, where a lot of people just prefer to bank with the big four. And banks will generally look at their profit margins, funding costs and competition before deciding what they pass on to borrowers. And if your bank doesn't drop your rate, then it's very, very simple. Move banks. Find another one. There's a lot of competition out there right now, and a lot of different terms and stuff like that. But I've got a list of banks that have actually confirmed that they're passing on the 0.25 rate drop in May. So Macquarie Bank are passing on from May the 23rd. Commonwealth Bank passing on from May the 30th. NAB passing on from May the 30th. ANZ May 30th. Bankwest May 30. Suncorp May 30. People's Choice Credit Union, May 30, AMP in June, and then Westpac, ING, RSEQ Bank, Bank of South Australia, Bank of Melbourne, St George is June the 3rd. Some lenders like Athena and Unloan have already applied the rate cut to their clients as well, which is great for them guys. So if you bank with them, well done. Never heard of them. I've heard of Athena, but I don't have any loans with them so far. So what does this mean for you as a borrower? Whether you're, an investor, an owner-occupier, anybody living in their own home as well, it essentially means that your borrowing capacity goes up. And borrowing capacity means that you can borrow more money from the banks. When interest rates drop, banks can lend you more money because your repayments are lower. So what that looks like for a couple earning 150 grand a year with no kids, they can now borrow around $17,500 more than they could before this rate cut came out. We're just talking basic investment here. We're not talking about HMO stuff, because HMO is a little bit different. A single person earning $90,000 see a jump of around $10,000 to $13,000 in borrowing power. Don't forget, when you are applying for a HMO mortgage, the lenders that we work with use the income that that property generates to increase your borrowing capacity, which means you can service a much bigger loan. So I don't have the figures yet from what that means from the lenders that we work with. This is more for the 0.9% of the market that are out there now with the normal lenders with a normal product. So $17,000 for a couple and 10 to 13k for a single person might not seem huge, but it's a very competitive market, and it can push you from a 2-bedroom house into a 3-bedroom house potentially. It could also push you from like an outer ring suburb, like one of these heavily smashed investment suburbs like Armadale, Ellenbrook, to a more central option. And it's definitely not going to get you from like Armadale to Como or Armadale to South Perth, but it might get you somewhere like Maddington, Beckenham or Nollamara. Like, still a better suburb, still not premium suburb, but this is the sort of jumps that people can be making to move from one suburb to the other. It also means that if you've already got a mortgage, your monthly and annual payments will decrease. 0.25% drop means on a $400,000 loan that you're saving around $61 a month or $732 per year. On a $500,000 loan, it's around $77 per month or $924 per year. On a $600,000 loan, you'll save around $92 per month or $1,104 per year. On a $750,000 loan, which is roughly where the median house price is right now, it's roughly $115 per month or $1,380 per year. And just to round it off, on a $1 million loan, expect to save $154 per month or $1,848 per year. So how will this affect the market? Because that's what we want to know, right? We've all been hanging out for this rate cut. It's finally come. I was really hoping that we'd get 50 basis points, which would have really lit that fire underneath the market, which, it's just simmering right now. I feel like it's boomed, it's just simmering, and it's just ready for the next push, because we've still got a massive undersupply of housing. I don't care what people are saying out there about people are leaving the Perth market. We've still got a massive undersupply of housing. And I don't believe people are leaving the Perth market. We sent a newsletter out to our database today, and we had close to 100 inquiries off one property, which was phenomenal. A lot more people than we expected. So first home buyers, you've now borrowed more, but so can everybody else. So whilst you now think that you've got more money to play with, or you've got a higher purchase price to go up to, so does the other people that you were competing with last week. So that means that prices could just follow and just go up, the same as your borrowing capacity is now gone up. For the upgraders, for the people that wanted to move into a bigger home or a better suburb that they've been eyeing up, that kind of adds pressure into that mid-tier pricing range, which is where I believe we're going to see a lot of movement over the next 12 to 24 months. And we're talking like the $750,000 to $2 million sort of price bracket. I believe that's going to go really well, and I believe that's going to drag them bottom sort of tier suburbs up there as well. For the investors, it means cheaper money, obviously better yields because their holding costs are lower, which means their cash flow is a little bit higher, which means people will then start buying, get the market moving again. And this cut will attract more investors back to the market. It'll attract them back into the market on the standard investment product and into HMO stuff as well, because every time a rate drop happens with HMO, the cash flow jumps by $5,000. We did a feasibility early from 6% to 5.5%, and that 50 basis points give the bottom line $5,300 of additional cash flow just by dropping that rate by 0.5%. Sellers, what does that mean for you guys? Firstly, if you're selling and you've got nowhere else to move, then you're just going to end up getting caught in all the competition that's going on out there. But it does mean that buyers have more confidence, and it means that buyers can pay more money for the property that you're selling. But, I'm guessing you've got to live somewhere unless you live in a rental property. And then rental properties are pretty tight still as well. So before we wrap it up, let's have a quick look at what's happening right now in the Perth market. And these are based on the RBA stats, and these are the stats that I've been tracking every single week just to see where the market's sitting, what's moving, what's not moving. Interesting that, RBA is still saying that we're almost at a balanced market. The vacancy rate's 2.5%, but the actual properties available for rent is still close to 2,000 properties, which is very similar to what it was 24 months ago or 12 months ago when the vacancy rate was 0.7%. So for that to happen, for the vacancy rate to increase, it means there's less properties on the market now because the available properties is still the same. Properties for sale, 3,059 houses and 1,026 units for a total of 4,744 listings. It's definitely up on what it was previously. I'm just going to try and pull my screen in so I can have a quick look at it. Yeah, same week last year we had 3,511 properties, so we essentially got 1,000 more properties on the market for sale. But REWA used to say that a balanced market is 12 to 13,000 properties, but that was also when the population in Perth with 2.5 million. We've just ticked over 3 million. So surely that balanced market figure has got to increase along with the population. So I believe now, let's throw 15,000. So we're still about $11,000 undersupplied for properties on the market to be a balanced market. Where's my little note that I had? So it's still tight, still 11,000. Under where we need to be. Median house price for Perth now is $775,000. 2-bedroom homes are sitting at $743,000 median house price. 3-bedroom homes are sitting at $700,000, which is interesting. I'll come back to that in a second. The 4-bedroom homes in Perth are currently median house price $845,000. Now, why are 2-bedroom homes worth more than 3-bedroom homes? 3-bedroom homes generally, and this is my assumption, but 3-bedroom homes generally are being built by developers. They're generally smaller. They're generally on smaller blocks. 2-bedroom homes are generally on development blocks, like the old fibro shacks. 2-bedders, which developers are probably buying, knocking them down, and putting 3-bedroom houses on there, which is why I believe that 2-bedroom price is higher than the 3-bedroom house. 3-bedroom price. And then the median weekly rent in Perth right now for houses is $680 per week. 2-bedroom houses rent out for average $600 a week. 3-bedroom houses are renting out for $650. 4-bedroom houses rent out for $730 a week. We've got 1,673 houses and 710 units, totaling 2,384 rentals, which is still very, 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 very low for Perth, of a population of 3 million. And on average, they reckon in Perth we have over 700,000 people that rent. 700,000 people, and only 2,300 properties are available for rent. Now, as I mentioned earlier, that figure has been relatively, look at this, I've actually got the stats in front of me. This week, 2,384. 4 weeks ago, 2,245. And the same week last year, 2,326. So there's 58 more properties on the market this week than there was this time last year. But somehow the vacancy rate, I keep going on about it, but I believe it's false advertising. It gives people the wrong impression that the market is actually adjusting when it actually isn't. There's actually less properties available for rent because we've still got the same amount of properties on the market. I'll stop going on about it. Don't worry, guys, I'm on my soapbox. This week there was 404 houses rented and 202 units leased, so there's still very strong demand in that space. Sales activity, 679 houses, 84 units and 59 blocks of land were sold this week. Let me just have a look at what that looked like last year. There's actually more sales activities. This time last year, 850 sales. This week, 122 sales, so more houses are selling. And properties for sale, there's more properties on the market for sale, which probably is why we're seeing more properties or more transactions this week. But Perth market's still low, very, very low. Still a long way to go. There's still strong activity. There's still very limited supply. Prices are holding firm. A couple of these fringe suburbs are seeing challenges selling properties, and we're talking about Mandurah, Armadale, Rockingham, Gosnells, all the areas that these investors jumped into to ride the wave, and now they're trying to jump back out and take the money back on the east coast. But there's reasons why we avoided them suburbs, right? We bought in Rockingham long before people were talking about it being an interesting suburb to invest in, and we were picking properties up there for $350,000, $400,000, and then renting out for $1,300, $1,400 a week. Some incredible result for our clients, and that then properties are worth $700,000. Excuse me. So final thoughts, guys. Let's just wrap it all up. I know it's a bit of a short one this week, only 16 minutes in, but RBA's slashed the rate by 25 basis points. It's now 3.85%. CBA, NAB, NZ and Macquarie have already committed to passing the cut on, and For borrowers, that means that your capacity is up from $10,000 to $17,000 additional, and repayments are down around $154 a month on a $1 million loan. Or yeah, you could buy a better property, you could upgrade from the suburb that you're in now into a better suburb. There's still a lot of work going on in the fringe suburbs. So people might be selling the house and land package that they've built and trying to get into a better suburb. The Perth market's still tight, less than 5,000 listings, fewer than 2,500 rentals. Median prices are rising at $775,000. Rents are climbing now, averaging $680 for houses. Years on market's low and competition's still strong. I believe this rate cut will just increase the demand even further, and we're not building nowhere near enough houses again. Supply still isn't keeping up with demand, and when demand outstrips supply, one thing and one thing only can happen: prices go up. Prices cannot go down until supply outstrips demand. So if you haven't already, now is the time to speak to your broker, because you could be moving forward with that investment that you were stuck on. If you are investing in standard residential properties, why are you even listening to this podcast? We invest for cash flow, right? Because equity is vanity and cash flow is sanity. The amount of investors I speak to that have got a very, very strong equity base, and for a long time now, they haven't been able to access that equity because their cash flow is so low, negative, and they're pouring money into their portfolio to keep it afloat. These people will hopefully be able to release some of this equity now with this rate cut, if not the next one. But this is the time now. After what we've all just been through, surely you will look at this and go, maybe this Neil Gibb guy's onto something. Keeps banging on about this cash flow thing, and interest rates went up and my cash flow was non-existent. So maybe it's time to start looking at moving some of this equity, now we can access it, into a cash flow positive investment option so that you can pay down the debt, get rid of the banks, and then who cares about the RBA cash rate in the future? That's a position I'm going in right now. I'm in debt reduction mode on my portfolio, using the cash flow to pay it down. So when the cash rate goes up, I'll be like, meh, who cares? So there you go, guys. Hope that was helpful for you. Bit of a short one today. Join us again next week on the HMO Property Show. And remember, every master was once a disaster. Every winner was once a beginner.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.